going. So welcome everyone. This is the first lecture in the Q speaker series. My name is Sri Krishnamurthy and I'm going to be the host for today. We are very pleased to have Dr. Reha Tutuncu from Point72 today. And in the next hour or so, we're going to have a quick introduction and we are going to talk about some of the practical issues on asset management. And then we'll have a fireside chat with Reha, and I would love to get his views on how he's seeing the investment environment today. Obviously, this is not investment advice, but how he sees the whole aspect about, with COVID-19 and how we are seeing the world in today's day and age. And also some advice on how do we think about careers, how do we think about upskilling ourselves, and how do we make sure that we are prepared as we come out of this crisis. I hope you're all safe, and I know when I looked at the registrations, we had people from all over the world. So I welcome you all to the launch of the QuantUniversity Summer School. So we have 8 weeks of classes we are doing in partnerships with Premier. And for people who do not know us, QuantUniversity is a Boston-based advisory. So we started out in 2013, and we have focused primarily on the intersection of data science, machine learning, and quantitative finance. We have had many programs, and we have focused primarily in upskilling quants and data scientists with the latest in various technologies like machine learning and artificial intelligence. So in the past 6 to 7 years or so, we have done many corporate programs, but in the last few years, we have expanded it into a lot of B2C programs, and we've been doing a lot of online programs. And we just had our first cohort of the machine learning and finance course, which we did in partnership with Premier. And we are launching the summer school, and we have 3 courses for people who are new to quantitative finance, and also for in the context of programming with Python and machine learning. So we have a course which gives them a quick introduction to Python for data science. And we have a 8-week course on machine learning and AI for financial professionals, which is being done in partnership with Premier. And we also have another course primarily focused on model risk management. So if you're interested in hearing about any of these courses, please go to our website, mlinfinance.splashthat.com. So without further ado, I would like to give you the agenda for today. For the next 30 to 40 minutes or so, we would love to hear from Reha on the various practical issues we are seeing with respect to asset management. And then we're going to have a fireside chat and a quick question and answer session. Dr. Reha Tutuncu is a portfolio construction lead at Point72 Asset Management. Prior to that, he has held positions at Secor Asset Management and also at AQR and Goldman Sachs. Prior to that, he was also a professor at Carnegie Mellon University. I came across Reha's work. So this was way back in 2008 when I was upskilling myself on the intersection of portfolio optimization. I was at a company called MathWorks doing a lot of MATLAB programming. And I was building case studies on using quantitative finance techniques, but also portfolio optimization techniques using MATLAB. And many of the books at that time were primarily focused on convex optimization and optimization theory. But the intersection of finance and optimization wasn't something which was ubiquitous at that point. So what we did was we were looking at potential books and research material, and I came across this wonderful book written by Reha, and that actually helped me kind of get a significant knowledge. And the book is in its 2nd edition, and I still advise everybody who's interested in portfolio optimization and finance to take a look at this book. We also use it quite a bit for our work, and also I tell my students at Northeastern University to refer that book when they are interested in the intersection of finance and optimization. So welcome, Reha, and it's a pleasure to have you at our first Q Speaker Series lecture. And I'll hand over the stage to you.
All right. Thank you very much, Sri. And it's a really big pleasure to be here and to have a chance to chat, with all the attendees of this seminar series. And thank you for that plug about our book. And yeah, so I think you can see in the background the cover of the second edition of the book, which came out just last year. So we had made a lot of improvements in the book, but I already feel that we need a third edition now, which requires a new chapter on investing through a pandemic or optimization during a pandemic. That's a sorely lacking chapter in the book, unfortunately. But also, I want to commend the QuantUniversity on this sort of initiative. I think in the world of finance, it's one of the sort of the fastest moving industries in terms of both the products and the approaches and the kinds of sort of methods that work, or the kinds of methods that don't work. So there's a lot of I think changes over time in the industry, and keeping up with these changes, there's continuing education and being aware of what's new, what's making a difference, what's making people more impactful is important, and initiatives like the QuantUniversity and the courses that they offer and these opportunities that they provide through these lectures and seminars, I think are increasingly important. And I'm really glad to be part of that and to be the first speaker of the summer seminar series. So let me. Can I take over the screen sharing now?
Yes, Reha, you're the host, so you can do screen share.
All right. So let's do this. So can everybody see my presentation now?
Yes.
All right, great. So as Sri mentioned, I decided to focus on a couple of practical issues in asset management for this conversation. And I'm a quant. Before coming into the industry, I was a math professor, so I love math. But for this particular presentation, I decided to focus maybe a little less on math and just maybe a little more on the the fundamentals and the approaches, the sort of the thinking behind some of the practical issues. So I think, except for one page in my presentation, there are no formulas in the whole set of slides. But I wanted to approach some of these things at a sort of more basic level than maybe some of you would prefer. Partly because throughout my career, as I did recruiting, or as I talk with people, I especially with sort of the people at the beginning of their careers, or people graduating from some of these specialized programs in computational finance or financial mathematics. There was really strong education in terms of the techniques and the methods. The tool set was there, but maybe sometimes they were not necessarily supplemented with the sort of the critical thinking around those kinds of methods. So I was hoping, or my objective in the talk is to give you a little bit of that sort of why do we do these things in a particular way, and why one thing matters more than others, or things like that. So hopefully, you'll find something, if not new, maybe a different way of looking at things in the presentation. So the two topics that I'm going to cover are factor investing and multi-period models. So without much more delay, let's get into the factor investing and what I'm planning to cover in that subject. So to get into factor investing, let me first outline the main components of a quantitative asset management process. So what does like quantitative asset management look like? And we can think of it as interrelated but relatively separate steps. And the first step is some sort of a forecasting model. So we want to, to be able to have a successful quantitative asset management process. What we need is a good model of future returns. So we want to be able to forecast returns as well as risks in the future, and then incorporate them into a portfolio that we manage. And this step is like, okay, you have a model of returns, but then what are like how are you going to actually express those expectations in terms of a portfolio, and this becomes the question of like optimal portfolio construction. So there are optimization techniques, and several of the chapters in my book, for example, are focused on that aspect of quantitative asset management. So how do we go from a return model to an actual portfolio? And then there is the question of, okay, you build a model, you have some forecasts of the future returns. Now you turn that into optimal portfolio that requires you to trade. So then that trade needs to be executed. So that's another aspect of the quantitative asset management process that requires careful planning and execution. And then the feedback loop. So once we do all of these things, we look at the performance of the portfolios we generated, we evaluate that performance, and we attribute that performance. Did we get returns from the sources that we expected to get those returns? Were they in line with our expectations? Were they bigger or smaller? How did they differ? Trying to understand this, and then use this information to try to improve those return models and to try to improve the portfolio construction and the trading processes. So, and these points also maybe are useful in terms of planning out different sort of career paths. A lot of these teams, at least in some of the larger asset management firms, are sort of collaborating teams, but they are separate. There's a research team focused on the alpha research, the forecasting piece. There's a portfolio construction team that's responsible for building the portfolios, and then there's a trading team. And the attribution can be done, I guess, the researchers or different, a separate group. But there is, risk management, for example, that can be a separate function. So all of these are also potential avenues of careers for those of you who are considering, the different types of roles in asset management. So these can all be options as you look for some place to build your career in. So let's focus on the factor models that comprise the first piece from the previous page. So we are trying to build a forecast of asset returns, and then we want to identify the ones that are going to outperform. And the typical way this is done in these multiple factor models is to decompose the returns into two pieces. The first piece is sort of figuring out the returns that are coming from factors that are prevalent throughout the market and that are shared, across the different securities. And then the second piece is the set of returns that are specific to the assets or securities in our portfolio. So this decomposition is captured using a multiple factor model. And there are several advantages to using a multiple factor model. So this gives us a thorough breakdown of return and risk. And we can incorporate some economic logic. So when we are building the factors, we can build them on, on our economic intuition. There are already, tons and tons of studies that documented the relationship between different factors and the impact they have on the returns of securities. So we can incorporate that knowledge that into the models that we are building. And the multiple factor models tend to be robust to outliers because they are focusing on these factors in trying to explain the returns of individual securities. They adapt to macro moments because some of these factors will capture the macro moments, and they tend to be flexible, tractable, and intuitive. And I think this is my only slide with the math formula. So just the composition, just writing it out in terms of a mathematical formula. So we write the return of a security in period t as a summation of different components. In that formula, the excess return of asset I is represented as the sum of the returns that are coming from different factors multiplied by the exposure of that asset to that factor. So that's the summation term on the right-hand side. So we have different factors indexed by K, and then for each one there is a factor return and the exposure of that asset. So the asset's return that's coming from that exposure is going to be the product of the two, and then we sum them over the different factors. And then there is the second part, the specific return of the asset, that's not explained by the factors, or the idiosyncratic part of the return. And so this is the fairly well-known multiple factor model that people use. And in matrix form, it's sort of has a very compact representation as, R equals the exposure matrix B times the factor return factor F plus the specific return factor U. So here, you can see the dimensions of the matrices or the vectors from my simple formula. Okay, so let's start discussing what a factor is. So what are the different factors that are important and how we can sort of use them for return or risk estimation. A factor is a characteristic of a group of securities that helps explain their returns and their risk. And these can be reflective of the exposures to systematic risks, but they are not necessarily earning a persistent premium. For example, industry membership is typically a factor of this type. So, like being in a particular industry, there are some industries where you can argue that they consistently earn a premium over the rest of the industries, but those could be more related to perhaps their beta or their riskiness, things like that. But in general, let's say there is not sort of an obvious reason that let's say the airlines should consistently outperform the chemical companies or something like that. So in that sense, there's not a persistent premium to be part of for being part of a particular industry. But these memberships help explain the risks of those particular securities. So they are included typically in risk models rather than alpha models. Other factors are related to risk premium. And these tend to earn a persistent risk-adjusted premium over time. So basically there is an additional risk for holding these factors, and people who hold these factors expect an additional return, a premium for holding these factors. So these reflect the exposure to these sources of systematic risk, and there's a return associated with it, and these risk premia type of factors are very common in multi-factor models. And then there are other factors that earn a persistent premium, but they are not necessarily explained as risk premia. And they sometimes are better explained through behavioral biases. Let me do a little bit of a categorization of the factors. This is fairly in line with what I was already saying. So we can talk about fundamental factors. These are based on sort of fundamental characteristics or sort of market data about the security. So like the industry membership, for example, that I mentioned is one of these fundamental factors, or the country membership in a multi-country global portfolio. By the way, I'm doing a lot of the explanations with a very sort of equity-centric perspective, but a lot of the topics and the concepts that I'm talking about, extend way beyond the world of equity investing. So, there's factors people think about in fixed income investing or in commodities investing, in FX. So these concepts go way beyond the equity world, but it's sort of the most familiar setting is the equity setting. So I'll stick to sort of examples from the equity setting throughout the presentation, but don't think that these are just for equities. The other set of fundamental factors come from sort of valuation metrics. These are, again, in the equity setting, sort of, based on the, for example, fundamental data about the company, their valuation, their, sales data, their revenue data, things like that, that impact, how valuable that company is or that particular security is. And there are also additional factors that we consider fundamental factors that are related to markets. And this is more about the prices, the liquidity, how much volume there is in that particular security. For example, momentum is about the persistence of returns. Reversal is sort of in a shorter time period. The tendency of the prices to revert after being sort of disrupted through some liquidity related nudges. Market cap determines the size of the company, so that again is related to this company security prices and the number of shares that are outstanding, things like that. There are also sort of macroeconomic factors that can be used in these multi-factor models. For example, sensitivity to inflation is important, sensitivity to oil prices, interest rates. So these are all sort of important factors that may impact one company more than other, and then you would want to incorporate that into your return models. And then there are also statistical factors that people use. So these come from typically something like a principal components analysis. So in this case, there's not necessarily an immediate economic interpretation of the factors, but they are reflective of either the returns, like if you look at them historically, so you can look at the correlation matrix of the returns and then try to come up with the principal components of that to use these statistical factors. So when does it start to make sense to start using factors as in return models? We can look at these return patterns in security prices, but they're not always easy to translate into a profitable strategy. So let's say, I conceived of a factor, I looked at, the cross-section of returns based on this particular characteristic, and I identified that, they, in this particular setting, if I form a portfolio this particular way, looking at that particular factor, I get good return. So when do we expect such results to be to translate into a profitable strategy? So there are a lot of tests that people need to make, and so if you open the the Journal of Finance, there are a ton of these types of studies, and you can see the kinds of tests that they do, and the practitioners also need to do a lot of these kinds of tests. And so the first, or the most obvious test that you need to do is the out-of-sample testing. So you try to come up with an idea, and then you try to validate that idea by because when you are researching your factor, you're doing maybe some calibration or some fitting, some parameter selection, things like that, and do these things continue to work out of sample? So that's an important point. The other thing that you would want to do when you are sort of building a factor and trying to figure out whether it's going to be profitable in the future is to make sure that it's robust. And when we say robust, we look at it in multiple dimensions. One of them is the different time periods. So does this if you have done a study of markets, let's say, or if you built a strategy, if you built a factor that worked from 2010 through 2017, that's a period where the equity markets, at least, were fairly low volatility, in this sort of bullish run, continuously increasing. No sort of serious market corrections in that period. So you may see that your factor is working in that period, but then if you start looking at periods that involve, the periods when the markets are dropping, and maybe the factor stops working. So that is not necessarily a good situation where you would have confidence of the factor working in the future. So you would want to make sure that the factor works in different time periods. Another sort of obvious test that we can do is, we built this factor using US market data. Does it work in Japan or the UK or Europe or other markets or in emerging markets? Or we may have built it for, using data for, let's say, large cap stocks, and does it work for small cap stocks as well? So these are the kinds of things that you can test. And if you only see that it works in some markets and not others, that again becomes a little bit of a red flag that you need to evaluate. Perhaps there's a reason for that. Maybe it works only in the US because, this is a factor that is reflective of some particular US tax rule that is not, in other countries, something like that. Maybe there's an economic interpretation for why it works someplace and not in others. But unless you have those kinds of interpretations or explanations, having something that's working very narrowly is not a good sort of sign for its sort of future predictability. And then another test is to apply it to different asset classes. Maybe you test it with equities. Does this idea also extend to fixed income or to FX? So this is another test. Implementability is an important consideration for building factors as well. So you may find a factor that works extremely well, but only in microcap stocks. So in that sense, so if you have a situation like that, that would indicate that, well, if you try to scale that strategy up, you will not be able to necessarily implement it at scale because, microcap stocks, you can only trade it so much. There are some, I think, questions that I am seeing. I don't know. Shri, can I ask you to sort of stop me and ask questions if they are coming through the...
Can we hold on till the end of the presentation, Reha, and then when we do the fireside chat, we can, take a look at these questions and then answer them one at a time.
Okay, that makes sense. So I hope the participants don't mind that. All right. Okay. And related to this implementability issue is the turnover and the trading cost. So if a factor requires excessive turnover and excessive trading costs, maybe it works in a sort of gross of cost sense, but not net of cost sense. So that's again an important consideration. So and it also becomes an important consideration when you're comparing multiple factors. So you have two researchers in your team, they both come up with their own factors, they bring them to you, one seems to work a lot better than the other one, sort of gross of cost, but then once you start looking into the details and the one that works better actually has twice as much turnover, and if you net the factor of the trading cost, then it's not as effective. These are the kinds of things that you would need to be fairly careful about when you're building these factors and testing them. Another consideration, obviously, is also, is this really a new factor? Is this something that exists already in my model? What's the correlation of this factor with the existing factors in my model? So these are all important things that we need to take into account when we are testing a factor. And I'll sort of wrap up this part of the talk by looking at a sort of a factor example. And this is a fairly well-known example. So the momentum factor is, open any sort of quantitative investing book, there's going to be a discussion on momentum. So this is the tendency of investments to exhibit sort of persistent returns in relation to other stocks for some period of time. And this is momentum is documented in every asset class in every market. I think my former colleagues at AQR published a paper called Momentum and Value Everywhere. I don't remember the exact title, but something to that nature. So they documented momentum and value as sort of persistent factors in different asset classes and different markets. In equity markets, momentum is about the relative performance among stocks, so not about market trends. So what this means is that we can talk about momentum as so like in a market that's rallying, if some set of stocks are going up higher than the other ones, those are the ones that have the higher momentum. And the ones, even though they may be also increasing, if they are going slower, they're going up slower than the rest, they have a smaller momentum. So that's the relative measurement that's important. And we can have momentum strategies working both in up and down markets. And they tend to work in sort of shorter horizons, of 3 to 12 months. A lot of the studies that document momentum look at that type of time horizon. And so how do you build the momentum factor? And a very simple sort of recipe would be something like this. We look at a measure of past returns. A typical measure is like the returns over the last 12 months, but excluding the past month, which sort of is usually done to negate the reversal effects. And then after we calculated this measure of past returns, we rank our assets in our universe according to this measure, and then we assign weights to them based on the strengths. So we overweight the ones that are highly ranked, and we underweight the ones that are ranked at the bottom, and then that gives you a portfolio of weights, and that becomes your momentum portfolio, and then you update your rankings and positions regularly by trading into these weights that you're generating this way. So very, very, very simple strategy. And although I oversimplified it, this is not really that different from a lot of the versions of momentum that you will see, in actual practice. And with factor investing, with different factors, a lot of the important considerations come from sort of understanding why and when they work. And so, again, I talked about all the different tests that you can do. In addition to those tests, I think it's important to have an economic interpretation of why this factor is working. So if you have done a back test and if you have generated, a successful looking factor, if you can explain why it's doing that, that's always important. That adds another dimension to whether you can expect that, return, that factor to sort of persistently generate those returns. One of them is this risk premium story. In the case of momentum, people looked at momentum as a sort of a risk premium type of factor, but the likely answer is no. But it's not universally agreed on. There are a lot of behavioral explanations. I mean, if you look for, just Google why does momentum work, I mean, you will see a ton of papers on this topic as well, and many of them look into these different behavioral explanations. Some of them will look into, for example, underreaction to news. So people hear news and then they do not immediately respond to that. It takes some time for people to catch on, and this generates momentum. So, returns start based on the news start appearing, but then they continue for a while as other people react to it. There's also sometimes the delayed overreaction type of explanation for momentum, or sometimes what people call the bandwagon effect. So, people see everybody's buying Facebook, so they feel that they need to buy it too, and then that adds to the momentum of Facebook. And these two bullets, although they seem a little contradictory, they are not, because they operate on different time horizons. Another sort of consideration or explanation for momentum is the disposition effect. Again, this is the tendency of people to, like when they are selling securities, they tend to sell the ones that gained and hold on to the ones that lost. So this creates a locking of the gains prematurely and holding out to the losses for too long. So these are all different kinds of explanations. So when you come up with your own factors, and you figured out, well, okay, I did these tests and this is what the data shows, you also need to be able to sort of, or you will want to look into why, for example, that particular factor is working. So typically, the process should be, you start with an economic reasoning, so like an economic theory. So I think there is this kind of logic that creates this kind of behavior or this kind of premia, and then start testing that rather than going the other way and looking at data and then trying to come up with an economic interpretation for that. I think I'm spending way too much time on this, so let me just move on to the multi-period models, and I'll go through this quicker, and maybe Dan will switch to the Q&A and the fireside chat. So in quantitative portfolio construction, we try to sort of find the optimal trade-off among three competing concerns. This is the return maximization, risk minimization, and then the T-cost management, minimizing the trading costs. And in a lot of the sort of the academic approaches, this T-cost part, the trading cost part is underemphasized or swept under the rug, but it's a very important consideration in practical asset management, and that's sort of the reason why sort of multi-period models are important. There are also constraints that we need to worry about. Trading costs reflect multiple things. So there are obviously some processing costs, the commissions and taxes you need to pay. There's the bid-ask spread that you need to take into account. And then there are the market impact costs. And the market impact costs are they come from the fact that when you are trading, let's say you want to buy something and there is a current quote depth, so people who are offering that security and people who want to buy that security, and they are matched, at a particular price point. But let's say if there are more people who want to buy than who want to sell, that price point is not going to hold anymore. You need to attract more sellers to the market, so that it requires the buyers to increase their bids, and they end up buying the security at a higher price than the current price. So that process, the way that changes the prices is called the market impact. And and with every trade, we are, changing the market, and we cannot really calculate the market impact prior to the trade. So this is not really an observable cost. It's between the transaction price and what the price would have been had there not been a transaction. We cannot really observe or measure it, but we can, build models of it and then try to take that into account. But they are hard to estimate. Let me just skip through these things. So this is a graphical representation of a transaction cost function. So there is at even as you start sort of trading more and more, a higher percentage of the daily volume, because you are demanding more and more of the security, that it's available, the impact is going to grow. So the more you want to trade, the more you are going to move the market price, and that's going to be a temporary change in the price, and it's going to revert. So you are going to basically lose that incremental cost, and that's why we think of that market impact as a cost. And typical models of the market impact is a sublinear function in terms of the unit cost, but then you start thinking about total cost of the trading. This becomes a superlinear function. Now, why are multi-period models important? So if you were to forget about trading costs, there is no advantage to considering multiple periods when you build a portfolio. You can always do it one step at a time. But if you are thinking about managing a portfolio and also managing your trading costs carefully, these single period models are not complete, or they have disadvantages. And this very simple scenario and an extreme scenario is we have let's say a portfolio of 2 stocks that we want to invest in for the next several periods. And let's say we have exact same risk and transaction cost estimates for these 2 stocks, but let's say the first one is going to overperform slightly in odd numbered periods, and the second one is going to overperform slightly in even numbered periods. Starting from let's say a cash only portfolio, and if you have low risk aversion, our optimal solution for period 1 would be to invest everything in stock 1, right? So if you have a higher risk aversion, then some mixing is going to make more sense. But in this sort of extreme scenario, I'm sort of ignoring risk aversion, so the risk that doesn't come into the picture, and we are sort of making a naive decision just based on the higher expected return for stock 1 in period 1. And then we come to the second period. If we did not have any aversion to transaction costs, if we ignored it completely, we would switch completely to the second stock with 100% turnover in the portfolio. If we had a very high aversion to the trading cost, then we would not trade at all and hold the suboptimal stock 1. So in this scenario, as I agree this is sort of a very extreme and simplistic case, but you can start to see that if you do not take transaction costs into account, or if you take them into account in a naive way, you end up with these suboptimal situations. And only if you start thinking about this multi-period model and the future transaction costs, you can discover the stable optimal allocation of 50-50 basically in each stock going forward. Multi-period models take these things into account and try to estimate the future costs and try to manage the turnover in the portfolio accordingly. And let me skip these. Sort of the important thing here is not only sort of considering the cost in the future periods, but also trying to come up with a model or how the return model will evolve in future periods. So this is related to understanding the signals, and going back to the sort of the factor models story. The expected returns, let's say we computed them as a composite of different factors, and we may have different types of factors in that model, some that move slowly and some move much faster. And the expected return of the portfolio at a rebalance point is going to be relevant only for a short period, and it will become inaccurate depending on how quickly your information is decaying. So between rebalances, our portfolio is becoming suboptimal, and then we need to keep rebalancing it to make it optimal. And that point, this multi-period model becomes important. So while maybe some components of my returns are relevant for longer periods, so I can afford to trade them at a slower pace, and the other components of my portfolio decay very quickly, so then I need to trade them at a much faster pace. So these are the dynamics that need to come into the picture for building these multi-period models. So a combination of taking future trading costs into account, as well as the decay pattern of the returns into account for building these models. And I'll finish with this sort of slide that can show you a sample situation where let's say you have a factor model that's decaying, and looking at two different scenarios of rebalances. One is rebalancing every week, the other one is rebalancing every 3 weeks. So what's happening here is that the blue line is the rebalance every 3 weeks situation. So at the beginning of each rebalance cycle, you do a sort of a big trade. You improve your expected return from, let's say, in this simplistic chart, from 6% to 12%. But after a week, some of that is already decayed, and you're down to 9, and then it goes down to 7, and so forth. In contrast, if you are rebalancing weekly, maybe you can do smaller trades. You will again experience these information decay in between rebalances, but maybe the average level of that orange line is higher than the average level of the blue line. So there are these interesting concepts related to multi-period models that you need to start taking into account. How quickly should I trade? How often should I rebalance? And these are all related to building good models of information decay, trading costs, and combining them in a meaningful way. So let me stop here and hand this over to Shri.
Thank you so much, Reha. So I am effectively using all the possible backgrounds of Zoom. So we are officially in a fireside chat now. I hope you can see the fireside. So I wish we had some more time. We have another 10 minutes. So I'm going to have, a couple of questions, just because, we have a lot of learners in the room. And then I'm going to take a couple of questions, technical questions. We have a lot of questions. I can email them to you, and, at your leisure, if you want to kind of, do a quick note, that's fine. But we do have a lot of questions. So the first question I have for you is, I didn't hear the term machine learning in your presentation. So what are your thoughts on machine learning? neural networks, synthetic data generation, all the buzz which is out there. So what's your thought on it, and how much of it is in practice at your organizations, if you're at liberty to talk about it?
I mean, I almost on purpose avoided, talking about different ways of building factors. So I just wanted to, give maybe more sort of principles rather than particular strategies for building factors. But machine learning is definitely one of the approaches people use for coming up with factors. So in factor investing, when you're trying to find an idea that's going to work, and you have a reasonably large data set, I think machine learning definitely can be one of the useful tools to try to extract information from that data set, to try to capture the patterns that may not be obvious to the let's say just simple tinkering. And now I raised a lot of questions about or not questions, but a lot of tests that you need to do to verify that the factors are going to continue to work in the future, and that's especially true for machine learning generated factors, because they tend to have less of or they often have a harder sort of economic interpretation than some of the other factors that are common in the marketplace now. But machine learning is definitely one of the areas that my organization included that people are focusing on for generating factors. Another I think important use of the machine learning tools is for capturing sort of nonlinear relationships between different factors. So sometimes, you may have a factor like the multiple factor models that I showed were, linear combinations of different factors, right? But you may actually find that maybe a tree structure, that's going through the different factors is more effective than a linear combination. So these kinds of discoveries are being made using machine learning techniques. So there's that second dimension, not only for factor discovery, but also factor combination, or turning them into a sort of an aggregate model. These are the areas where I think machine learning has a lot of promise.
Cool. The second question I had is regarding the bandwagon effect you mentioned. How much of it is the Robin Hood effect, and how much of it is just institutions kind of a thing? So would you be able to comment on it?
I mean, I think Robin Hood is a relatively recent phenomenon in terms of actually impacting the market prices, and I think I'm sure, very soon we will start seeing data that's documenting that effect. But historically, I don't think that was such a prominent effect. I think some of it does come from retail investors, the bandwagon effect, especially, I think a lot of these behavioral explanations make a lot more sort of intuitive sense if you start thinking about the retail investors compared to, let's say, institutional investors. But I don't want to put too much emphasis on Robinhood when its impact has been so new.
Okay, cool. So I'll switch to a couple of questions we have had in here. It's difficult to choose. So maybe next time we will have people send us questions beforehand so that we know what kinds of questions and we can aggregate them, and also look at some latent dimensions and focus on those latent dimensions rather than doing dimension reduction on the fly on the question. So one question, actually, this is one of my questions too. In backtesting, do you prefer historical backtests or simulations? what circumstances do you prefer one over the other? And I want to throw in a little bit of color too. In the course we did, in the last cohort, and we're going to be doing this cohort too, we have a component on synthetic data generation and looking at potential use of synthetic data generation, the synthetic data to augment simulations and scenarios. I don't know if you have any thoughts on that.
I typically, at least on the equity investing side, rely on backtest historical simulations. But I also, one sort of important reason there is that historically it hasn't been very easy to generate synthetic data that covers history that's really good at capturing the different interconnections between, let's say, the different factors you are trying to model, and things like that. Now, in my previous work, when I was a risk manager, so I used to think a lot about sort of the what if type of scenarios. So looking at, worst possible cases, things like that. And in those situations, I recognize that looking at historical data is not sufficient. And so we did do a lot of testing based on synthetic assumptions. So, and some of these were sort of very basic, what if the markets were to move 5%, 10%, and, you can look at the equity markets moving one way, the credit markets moving the other way, and the interest rates moving some other way. So you try to capture those kinds of scenarios. So, but again, in those settings, you are missing a lot of the the important interconnections if you are not modeling them, in a correlated way. If you are not taking into account, autocorrelations, if you're not taking into account cross-asset or cross-security correlations, when you're generating these scenarios, you have an incomplete picture of, what may go wrong or what may go right. But yeah, I think from a risk management perspective, you obviously need both sets. From like equity strategies, I think they both are important, but I tend to focus more on backtests, historical backtests.
Okay, so it's going to be really hard to choose one more question, but I'll choose one. So traditional low-vol portfolios haven't worked well this year. Any thoughts on construction heuristics, especially for high wicks, spiky wicks regimes?
So I'll pass on that question.
Okay. So
I don't have any sort of particular insight in that topic. So yeah.
Okay. So another question, which is probably topical, is how many factors are good enough, especially with all the alternative data and alternative vendors providing factors? How many are good enough? Is 5-factor from a French?
No, I think. Okay. So I think the more the better in general. There are a couple of things I guess I need to add to that. One is the factors do not stay effective for extended periods. So over time, say, some factors will lose their effectiveness, maybe because other people are using it, because they become well known and the juice is gone, and also new factors are coming. So I think in terms of building a successful return model, the more diversity you can have, the better. And that's not only because of the purposes of like cross-sectional diversification, but also for the different factors will be sensitive to different maybe macroeconomic environments. So one of the really fascinating articles that I've seen just last week was from Joe Mesrick. He's a well-known quantitative researcher, and he was talking about the big changes in the factor investing world and how the the very low interest rate regimes have fundamentally altered the picture for the well-known factors. So how they have, like, value has been, for example, underperforming for an extended period of time. And the previous question that you asked about the low vol portfolios, I mean, they are going through this significant sort of underperformance period, and they are reflective of different, I think, sensitivities to different market regimes. And the more sort of factors you can have in your portfolio in your multi-factor model, the more of a chance you will have that some of them at least will continue to work even in changing market environments.
Perfect. Yeah. Thank you, Reha. I think we are at 1 o'clock. I know you had a hard stop at 1 o'clock. It was an absolute pleasure having you, and I look forward to the conversation online. And by the way, we are going to be giving away a copy of your book to one of the attendees of today's webinar. So what we'll do is we will send out a survey, and we will have a question if you've been paying attention to Reha's lecture. And the question will be pulled from the lecture. So if you answer the question correctly, we will take that, and then we will run through our random number generator, which is very effective. It's not a pseudo-random number generator. It's a real random number generator. And we'll pick a winner, and we will ship you the book. So it's going to be a physical book, not an electronic book. So please, keep an eye on your email about the survey. And every week, we're going to have a speaker with an interesting topic for the next 8 to 10 weeks. So we already have the pipeline of speakers, and we're going to be sending out an announcement for the speakers. And if you are interested in learning more about the, so let me just take back the, would you mind passing the control back to me, Reha, for a second? I want to show one more link.
How do I do that? Let me see.
I think there should be an option. So if you click on the top right of mine thing, and then
sorry,
I'm also trying to figure out, but anyways, it doesn't seem like it's allowing me. So you'll have a link to the courses we are going to be offering in the summer. The summer school is starting tomorrow. We have 8 weeks of classes, primarily focused on machine learning, and it's in association with finance. And we have a lot of case studies, some aspects of natural language processing, some neural networks, some synthetic data generation, and a bunch of different case studies. We also have a model risk management class, which we are offering in partnership with Premier. That, again, is a 7-week class and a guided case study on how to do model validation, especially for machine learning models. So I hope you leverage those opportunities and continue your learning, and we will stay in touch. Thank you so much for today's attendance, and we'll see you hopefully in the next week. Thank you.
All right. Bye.
Thanks again, Reha.